Welcome back to the channel. As always, if you are copy trading, you are an absolute moron and you deserve to lose all your money. And with that out of the way, we're going to speak today about a stock called ATI Incorporated, ticker ATI. What do these guys do? Essentially, they are a manufacturer. And one of the reasons why I'm looking at this particular sector right now is because unlike in previous years where we saw a divergence on the ISM, where the services sector was doing pretty good and the manufacturing sector was not so good, we are seeing a recovery in the manufacturing side. But there is another tailwind for this particular stock. What they do is they provide specialty materials, and that typically is alloys, advanced alloys. The materials include titanium, titanium-based alloys, nickel. Essentially, all these type of materials and alloys are being used for defense purposes. And unless that you've been living under a rock for a while, you know that the Iran war has been happening for about a couple of months now. The argument can be made that whether the war comes to a halt tomorrow, or even if it continues, the supplies from the US Army have been depleted. And so that creates a situation where the US military is going to be falling into a restocking cycle. Now, that could be more prolonged, it could be not so short, but if we look at this from the lens of probabilities, we can think that it is very likely going to happen. So they depleted stockpiles of titanium and specialty steel. Those require immediate replenishment, creating a backlog of orders that will accelerate revenue for the next 2-3 years. Again, that's regardless of the war status. When we look particularly at this type of government contracts, uh, these are orders that are purchased well in advance. So we are not looking at a situation of months or weeks. We are looking at a much longer cycle, okay? And in terms of priorities, unlike commercial markets, defense spending is actually prioritized by the United States. The United States has committed nearly 900 billion in budget for 2026, with a specific pivot toward hypersonics and naval modernization. These particular programs require ATI-specific alloys, and those particular products have no viable substitutes, ensuring zero volume risk from price sensitivity. So when you look at this type of materials, they do have a moat in terms of the competition. We'll talk a little bit about that later, but the point is that it's just not good enough to make a cheaper product or even a better product, because in the case of cheaper, right, the US is a great customer to have. They will end up overpaying if it's necessary to get it done, even if it's not necessary. And in the case of a better product, it typically requires a long cycle of testing before it gets approved. So we are looking at likely bonanza, right, over the near and medium term horizon for a company like this. We also have to think about the commercial recovery in companies like Boeing, which has rebounded for quite a while, and Airbus ramping up production. The commercial aerospace sector is adding a secondary growth engine, offsetting any potential downturns in on the industrial sectors. So, for example, if we were to look at Boeing over here, is a company that was in serious trouble in previous years, right? But as you can see, they are starting to come out of it and are trading right now because of government intervention at very high multiples. So it looks pretty good in terms of macro perspective. We have strong manufacturing. We also have good demand dynamics for this company as well. What about their supply capacity? At the moment, they're operating at 90 to 95% capacity utilization. That is definitely a good problem to have. They are also expected to introduce new capacity, taking 12 to 18 months to come online. But of course, as you know, the stock market does price these kind of future expectations into the price. At the moment, demand exceeds supply. And coming back to the competitors, which is one of the main risks for this idea, right? Companies like Carpenter, for example, ticker CRS, do compete in a similar space to them. Again, the strength that we see in this competitor is a signal that ATI does have this tailwind, right? So we would expect a company with a similar business model to perform similar to the stock that we are looking at. Having said that, it cannot instantly capture ATI defense revenue because, like I said, defense military qualification takes between 3 and 7 years. So that makes ATI effectively a certified monopoly for many critical alloys. The other potential risk, but I think is minimized, is of course to buy from other suppliers from overseas, not necessarily from the United States. Yes, that is a possibility. But as we've seen, the current administration is prioritizing buying from in-house, right? Buy America. And of course, some of these suppliers are based in countries which have sanctions, such as Russia, effectively blocking that foreign competition. So yes, it is potentially a risk, but it's something that if it manifests will become clear, it will become apparent very, very quickly and easily. So the question that we have to ask ourselves as now is, well, okay, the tailwind, all these kind of things that are been happening so far, and even where the company is today, that seems to be very good. But what about the future? What if we look at this from a forward-looking basis? At the moment, the company has been going through some revenue misses. Okay, so we go to the previous earnings history. We can see that they've had 2 consecutive quarters of revenue missed on their quarterly report. And yet, overall, the stock price was positive in both of them. Okay. That's partly because EPS was a bit, but also it signals that the market recognizes that demand that is coming through the door for these guys. Restocking orders hit the books at a very high volume, right? Escalation clauses in long-term contracts kick in, allowing ATI to pass through higher metal costs. And also, they're selling more high-valued machine components rather than raw materials, boosting revenue per profit. That current environment allows them to focus on higher margins business, okay? And that results also in a margin expansion. So if we go to the expected revenue growth for the company, we can see that is gonna take place, but also accelerate. So yes, it was a little bit disappointing in the last few quarters, but management expects for that to catch up and actually continue growing, which is of course a positive thing. That will also result in gross margins expanding all the way from the low 20s where we are, all the way to the high 20s. And the same thing happens with other metrics like EBIT and EBITDA margin. So all that creates significant growth sustained over the next few years, right? We can see that from last financial year all the way up until 3 years from now, EPS is expected to double. So all those things create a pretty good, pretty solid environment for us to consider going long this stock. The volatility is also something we like. It's just under 50, and that creates a situation where a target price of around 200, right, is very achievable. So the way I've structured this is with a calendar spread, buy a couple of 21st of August 160 calls, and sell one contract of the July before the earnings report as well. That provides us with more than 100% payoff, and that is before earnings, leaving us with the option to restructure. Okay. So in this particular case, price is secondary. In defense, reliability and certification trump price. A 10% cheaper alloy from a competitor is irrelevant if it lacks the 3-year or 7-year military qualification. And also, having a US-based vertically integrated supply chain is a strategic asset that will certainly be perceived well by the government. Competitors cannot offer the same certainty of supply that the Pentagon demands, especially during geopolitical instability. And their ability as well to pass through higher costs to the clients protects their business from the cost fluctuations. In summary, the company sits at the intersection of irreplaceable demand, constrained supply. The company is positioned to beat revenue estimates in the near term as the defense cycle matures, while its pricing power and moat protect margins from competitors. The fundamental setup suggests a multi-year growth trajectory that is largely insulated from short-term geopolitical risks. And the release of the next quarter, sometime in late July, will provide us with that turning point in revenue growth, catching up to the EPS beats that we haven't seen just yet. So we'll look for guidance updates on backlog expansions too, and of course monitor the situation in the Iran conflict to see how the probabilities on that front continue to evolve. Hope you enjoyed the video. See you soon.